I research retirement strategy for a living, and the single most underused tool I see among people in their 50s and 60s is sitting right inside their 401k plan. According to the Federal Reserve's 2023 Survey of Consumer Finances, the median retirement account balance for Americans aged 55 to 64 is just $185,000. For many households, that number falls well short of what they will need. But here's the encouraging part. The IRS has built a specific set of rules designed exactly for this moment. In the next 10 minutes, you will understand what catch-up contributions are, what the 2025 limits look like, why a brand new provision called the Super Catch-up could matter enormously if you were between 60 and 63, and how to think about whether any of this fits your situation. Let's get into it. What is a catch-up contribution? Let's start at the foundation. A 401k catch-up contribution is an additional amount the IRS allows workers aged 50 and older to contribute, on top of the standard annual limit. The idea is straightforward. People who started saving late or who paused savings during difficult years deserve a legal mechanism to accelerate. Congress formalized this in the Economic Growth and Tax Relief Reconciliation Act of 2001. It has been part of the tax code ever since. Here is why this matters structurally. Every dollar you contribute to a traditional 401k reduces your taxable income in the year you contribute it. That means a catch-up contribution does not just grow your retirement account, it also lowers your tax bill right now. How much that matters depends on your tax bracket. Someone in the 22% bracket saves a different amount on their taxes than someone in the 32% bracket. Your specific situation changes the math considerably. The catch-up also benefits from compounding. Even contributions made at age 55 or 60 have years to grow before most people begin drawing down. The earlier inside this window you maximize, the more compounding time those dollars have. That context matters as we look at the actual numbers. The 2025 IRS Standard Limits. Here are the specific numbers for 2025. According to the IRS, the standard 401k elective deferral limit for 2025 is $23,500. That applies to every eligible employee, regardless of age. For workers who are 50 or older by December 31st of the contribution year, the standard catch-up contribution limit adds $7,500 on top of that. That brings the total potential contribution to $31,000 for most people in the 50 and over group. These limits apply to 401k plans, 403b plans, most 457 plans, and the Federal Thrift Savings Plan. So if you work in the public sector or for a nonprofit, these same rules generally apply to you. Your specific plan documents govern the details. Not every employer plan allows catch-up contributions, even when the IRS permits them. It is worth confirming with your HR department or plan administrator. One more thing to understand about the $7,500 figure. The IRS adjusts contribution limits periodically for inflation. The $7,500 catch-up limit has held steady since 2023. Prior to that, it was $6,500. Staying current on IRS announcements each fall, usually in October or November, is how you ensure you are working with accurate numbers. The Secure 2.0 Super Catch-up, ages 60 to 63. This is the section I want you to pay close attention to. The Secure 2.0 Act, signed into law in December 2022, introduced a provision that took effect in 2025. It is called the Super Catch-up Contribution, and it applies specifically to participants who are aged 60, 61, 62, or 63 during the plan year. According to the IRS, for 2025, the Super Catch-up limit for this age group is $11,250, replacing the standard $7,500 catch-up for those 4 years only. That means workers in the 60 to 63 window can potentially contribute up to $34,050 in total to their 401k in 2025. Once you turn 64, you return to the standard $7,500 catch-up amount. Why this 4-year window? The legislative intent was to create a concentrated savings sprint for people approaching retirement at high risk of underfunding. If you are currently in that age band, this is a time-limited opportunity. It does not last indefinitely. Whether maximizing it is feasible depends entirely on your income, your expenses, and your household cash flow. Your filing status and other financial obligations change what is actually achievable. This is a number worth knowing, and then stress testing against your real budget. Roth 401k. vs. Traditional. Which framework fits you? Many employer plans now offer both a traditional pre-tax 401k and a Roth 401k option. The catch-up contribution limits we just discussed apply to the combined total across both account types, not separately to each. You do not get $31,000 into traditional and another $31,000 into Roth. The limit is shared. The strategic question is which bucket makes more sense for your catch-up dollars. In a traditional 401k, contributions reduce your taxable income today. You pay taxes on withdrawals in retirement. In a Roth 401k, you contribute after-tax dollars now. Withdrawals in retirement are generally tax-free. The right answer depends on whether you expect your tax rate to be higher now or higher in retirement. According to Vanguard's 2024 How America Saves report, 89% of Vanguard-administered plans now offer a Roth 401k option, up significantly from prior years. Access is no longer the barrier it once was. The choice between pre-tax and Roth is genuinely personal. It involves your current income, your projected Social Security income, your expected retirement spending, and whether you anticipate significant required minimum distributions. A tax professional or fiduciary advisor can model this for your specific numbers. What I can tell you is that both paths have real value, and understanding the difference is the starting point. Making the math work on a real budget. Knowing the limits is only half the equation. The harder question is, how do you actually free up the dollars to contribute more? According to the Bureau of Labor Statistics 2023 Consumer Expenditure Survey, Americans aged 55 to 64 spend an average of $66,140 per year across all categories. Housing is the largest single expense category. For most households, creating meaningful catch-up contribution room requires either increasing income, reducing fixed or discretionary spending, or some combination of both. There is no version of this where the math does not require real trade-offs for most families, a few structural levers that are worth understanding. First, many employers offer automatic escalation features, where your contribution rate increases by 1% per year automatically. Enrolling in escalation does not require you to find a large lump sum. It distributes the adjustment over time. Second, a windfall strategy, directing tax refunds, bonuses, or inheritance into your 401k catch-up, can supplement regular payroll contributions without changing your monthly cash flow. Third, timing matters. If you are in the 60 to 63 super catch-up window, prioritizing those years over adjacent years has a mathematical basis. The higher limit is temporary. None of this is simple. Every household has different fixed obligations, different income stability, and different health considerations that affect how aggressively to save versus maintain liquidity. Your own picture is the only one that actually matters. These are frameworks, not formulas. Disclaimer and next steps. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this video helped clarify how catch-up contributions work, please subscribe. This channel is built for people who are serious about understanding retirement strategy, not just looking for generic reassurance. Every video is sourced, every number is cited, and the goal is always to give you the knowledge to ask better questions. Next up, we are breaking down IRA contribution limits for 2025, including how a traditional IRA and a Roth IRA can work alongside your 401k, and what the income phase-out rules mean for your specific situation. That video is already on the channel. This video may contain affiliate links. I only recommend tools I use personally. Thanks for watching. I'll see you in the next one.